Gold prices have finally seen a run up, but many of you are physical buyers of the metal, and here to talk to us about physical demand with gold is Marcus Grubb. He is the managing director at the World Gold Council. He's the managing director of investment. Marcus, so great to have you in the studio.
Thank you.
So the talk of demand, physical demand, has been a big discussion in April. It's a big discussion right now. What are you seeing on the physical demand side?
Yes, it is. It's a very good year for physical demand this year, and I think that's the big message from the figures. We've seen a very strong Q1, then we had the big price drop in April. You saw huge physical demand come in Asia as a result of that price drop, and then since then you've seen demand continue in India and China. China's probably going to come in between 900 and 1,000 tons this year for full year. Last year was a record at 776 tons, so that gives you the best indicator.
Why so much in China? Why?
Yeah, I think it is a number of things. China deregulated its gold market 10 years later after India, so there's always been a catch-up effect. They're rising on a steeper curve than the Indian market in terms of buying gold. That's number one. Number two is, I think, increased economic uncertainty in China on inflation, on credit, on the growth in the economy actually means Chinese consumers buy more gold. They buy it as a hedge, and so they're buying it also for those reasons.
Yeah, do you think this mixed bag of economic news that's coming out of China, we saw, GDP's softening a little bit, that's contributing to it as well?
I do think so, and I think that at the margin, slowing growth in China doesn't affect gold demand that much. I think it'll affect demand for other metals that are used in infrastructure. But remember, gold is really a saving asset on the one hand, and it's a consumer product on the other in the form of jewelry. So long as consumption continues to grow, you will see strong demand for gold in China.
What about India? We've seen, the taxes put on imports there. Is that still a trouble?
It is, in that India has problems with its current account deficit. The government is concerned about rating downgrades for the country's sovereign debt, and so they're trying to reduce the deficit. And one of the ways they're trying to do that is reduce imports of gold. Now, the problem is, by taxing gold, raising import duties, affecting the credit for importing gold, they're just creating a big grey market. We think the grey market might be probably $10 billion this year, could be as high as 200 tons. That's a lot of gold coming in through unofficial channels into India. So ultimately we think that's not the right way to solve the problem. There are other ways you could do it, other things you could do to improve the current account deficit. And Indians love gold. It's deep in their religion, mythology, culture. So you're not going to reduce gold demand in India.
So let's move from the grey markets of India to the markets of the US. How's physical demand look here?
Physical demand in the US is good in jewelry. We've had the best print since 2005 in Q1, and I think that reflects the improving economy. On the other hand, of course, you've seen a complete switch around in the market for investment gold in the US. You now have a big short position in futures, where for 12 years of the bull market we had a big net long. We're now just a small net long and a big short. And that's really based on a belief that the economy is improving, the Fed is going to taper QE, going to raise rates soon. And on the other side, I think you're seeing the ETFs put tonnage back into the market. So on the back of that changed view, you've had about 350 tons of ETF gold come back in from GLD in the US, about 600 tons from ETFs globally in the first part of this year. But all of that has pretty much gone to China.
So the outflows in ETFs, the record outflows we've been seeing in 2013, are actually creating more supply in the physical world.
They have, and I think the key is, our view is this correction is going to be very quick and very steep, and it's almost pretty much over already. Because what has happened is that gold's come in the first 7 months of the year, 6 months, 7 months of the year, 600 tons, 300 in the US. It's immediately been taken up by the huge demand in India, China. And then on top of that, you're going to see recycling drop this year. Jewelry demand's probably going to rise because of the lower gold price. And you're going to see mine production probably come in below expectations because, of course, all the gold mining companies have to cut back on spending when the price is where it is today.
Right.
So I think balance is already being restored in the gold market. And then if you look forward from this year into the future, tapering's already priced with gold down 30%. I don't think tapering will pan out as easily as everyone believes it will. I think a flip-flop scenario is more probable in the next few years. Then I think gold has a lot of potential to continue to do well.
So I wonder then, all the analysts, or many of the analysts, said there was a lot of physical support in mid-April. We're not seeing as much now. What do you think?
I think that's true in absolute terms, but it's all relative because this is the weakest time of year for gold demand on a seasonal basis anyway. So when they say that, they're right, because we had a huge surge on the price drop in April. But if you compare to the normal level of demand for this year compared to last year, it is still at high levels. You've got premiums in India of about $12 to $13 an ounce. Normally it might even be negative this time of year because of the monsoon. And then in China it's running at about $20 an ounce. Last year it would have been $7 to $13 an ounce premium on Shanghai. So even with lower levels of demand because of seasonality, it's higher this time of year than it ought to be.
All right, Marcus. Well, thanks for giving us the outlook on physical demand right now.
Thank you.
For The Street, I'm Joe Deaux.